Hello everyone, my name is Devin Bertrand and this is my strategic planning project using DuPont Identity as a tool to help compare my company, Facebook, with the likes of Twitter and the rest of the information retrieval services industry. As a general company overview for Facebook, since Facebook co-founder and current CEO Mark Zuckerberg launched the site in 2004, the company has grown exponentially through the years. With the introduction of the like button and personalized timelines, the company not only looks to improve the quality of their website for active users, but they are also looking for ways to increase the bottom line. With an estimated 2 billion users on Facebook, the company has seen financial success without ever having to charge users to create an account. Facebook generates revenue primarily through advertising and the fees associated with application developers. Company executives decided in 2012 they were going to take the company public and issued an IPO with a peak market capitalization of $104 billion. Unfortunately for the company, the IPO did not reach the highly anticipated results they were expecting and saw the stock price drop significantly over the following months. However, as time passed, the technology giant regained upward mobility and now sits with the likes of Microsoft and Apple as a few of the only technology companies that have reached a $300 billion market capitalization. As most of us now know, the DuPont identity of any company or industry is the deconstructed foundation behind their return on equity. There are three components or ratios that make up a company's return on equity: profit margin, asset turnover ratio, and equity multiplier. A company's profit margin measures the overall operating efficiency by examining the relationship between the net income and sales. A company's asset turnover ratio measures what level of sales a company generates in relation to their total assets, and the company's equity multiplier is used to gauge their long-term ability to pay off financial obligations. As we break down these three ratios further, we can see the return on equity is ultimately determined by a company's net income, sales, total assets, and total equity. More specifically, profit margin falls under the profitability ratio's umbrella. As profit margin is presented as a percentage, the ratio indicates how much of every dollar of sales a company actually keeps in earnings. For example, as depicted in the graph, Facebook recorded a profit margin of nearly 37% in 2016. This percentage was far superior to their closest competitor, Twitter, who saw a negative profit margin due to a negative net income. Since 2014, Facebook has had positive growth in both net income and sales, resulting in a slightly above average profit margin over other companies listed within SIC code 7375. As we look at the asset turnover ratios, we see a much different landscape. In the past 3 years, both Facebook and Twitter fell short of the industry average of 50%, but for varying reasons. As it has been reported, prior to Facebook's decision to take the company public, the company has had a very strong asset turnover ratio of nearly 80%. Since the company saw a significant inflow of cash after the IPO, ultimately increasing their total assets, the company has been criticized that they are slightly less effective in driving sales with assets on hand than other industry leaders. I am confident that Facebook's total asset turnover rate will return above industry averages in the upcoming years due to their upward moving trends of sales over the past 3 years. As can be seen on the graph in the information below, in 2016, Facebook generated 42 cents in sales for every dollar of assets they possess. Of the three components that make up DuPont identity formula, Facebook is well below their competition in the equity multiplier ratio. Although a low equity multiplier ratio is not necessarily a bad thing, it does suggest that a high percentage of assets are financed with the use of equity instead of debt. As we compare Facebook to Twitter and the rest of the information retrieval services industry, we see that Facebook can cover their assets nearly 1.1 times using only their stockholders' equity. I believe that Facebook's decision to use equity financing more than their competition stems from their below average efficiency on asset usage. As Facebook's total asset turnover rate continues to grow, I believe that the company will employ a strategy that uses more debt in the near future. Through the product of all of these components, Facebook maintains a strong position within their industry for return on equity. With industry trends moving upward, Facebook and Twitter are seeing similar trends themselves. In Facebook's instance, the large increase in return on equity in 2016 stems from a combination of increases in profit margin and asset turnover ratio. As long as sales continue to increase at a slightly greater pace than assets, I expect to continue to see steady increases in these categories. To label Facebook's generic competitive strategy, the company most closely falls under the best cost provider strategy, but has a unique spin on it. The best cost provider strategy looks to capitalize on bits of the other four possible generic competitive strategies, but by taking a middle ground approach. While we believe Facebook offers a high-quality product for an economical price, there is an interesting dynamic based on who is providing the revenue streams. For the social media company, and mostly all successful social media companies, the average user does not pay for an account. In fact, the company wants as many people as possible to possess accounts because the increased usage leads to a greater opportunity to sell advertising. In today's digital age, advertising or promotion has shifted from print to online because of the ease of creation, economical advantages, and level of distribution to massive amounts of people. However, Facebook has developed an advertising platform that allows companies of all sizes to dictate their budget within Facebook and a targeted number of individuals they want to be reached. This customized approach has allowed companies and organizations who are looking to spread the message to a targeted group of people the ability to do so without breaking the bank. The decision to employ this competitive strategy is a smart analytical decision based on Facebook's internal capabilities and the industry they compete in. A best cost provider strategy is best suited for companies who have the resources and capabilities to incorporate attractive and upscale attributes to its product offerings at a lower cost than rivals. Facebook has the technological resources to meet any client's demands, over 2 billion active users, and a platform to meet the budgetary requirements that a company can afford. All of these attributes allow Facebook to provide the broad-scale advertising for large companies, the narrowly defined advertising for small niche companies, and both of these opportunities at a price that their clients can dictate. As interesting of a dynamic as Facebook's business model is, the company's competitive strategy is just as complicated. The company employs a wide variety of strategies when dealing with different competitors in their industry. Facebook has been known to take an offensive approach when adopting and improving on the good ideas of other companies, a defensive approach in preserving their market share, and an acquisition strategy with the likes of Instagram and WhatsApp. It is important to address how the company creates revenue through advertising, but is only successful in doing so if there are large quantities of active users on the site worldwide. Facebook is always looking to provide the best quality technological product to ensure users remain connected, and companies want to promote their products through this media outlet. As we circle back to Facebook's return on equity, we believe the way the company can increase this ratio is by increasing sales on an annual basis. In order to successfully do so, Facebook should focus their efforts on an offensive, competitive attack with the intention of exploiting competitors' weaknesses. Facebook is already the world's leading social media site, but the company's roots stem from technological advances that other companies simply cannot offer yet. The company prides itself on creating a culture of innovation through the recruitment of talented young professionals who can bring a culture of innovation by being the first adopter of next-generation technology, improving upon the unprotected ideas of competitors, and acquiring companies whose services cannot be replicated efficiently. Facebook can ensure that they are offering services that are comparable or better than everybody else. By taking a best cost provider strategy, they are properly executing their plan of driving up the number of active users while making the opportunity costs of advertising with them an attractive option for companies. I hope everyone can gather some of the information that I learned through this assignment. Facebook is an incredible company that has been able to capitalize on innovation and effective management decisions. I thoroughly believe that the company's culture and business practices are reflected in their strong financial ratios. The company is growing year to year and quickly finding themselves as an industry leader. I hope everyone enjoyed this presentation, and I look forward to hearing criticisms and feedback. Thank you.